Welcome to the Wealth Setting Podcast Video Edition. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. In this episode, I want to talk about the Federal Reserve's interest rate policy and what you've been hearing so much in the media when they talk about normalizing rates. What exactly is normal rates and why would the Federal Reserve be talking about normalizing them? So, what's really normal about the Federal Reserve and their rate policy? Let's find out. Well, the only thing that's normal about the Federal Reserve's policy is that they consistently and constantly intervene and meddle with the economy to try and influence what type of part of the phase of the business cycle we're in. The problem is that they generally get it wrong, and you can go back to the origins of the Federal Reserve when they were first created in 1913. You can look at their failed intervention during the Depression years. And I think if you follow every business cycle since then, you'll see their ineptness. Now, for a while there, things did work pretty well for the Federal Reserve. Alan Greenspan was actually called the maestro for the way that he handled the economy. I personally think that had a lot more to do with where we were at with the ending of the Cold War, the introduction of really the third phase of the Industrial Revolution, when the internet and all types of information media became so important, and the way that drastically transformed our economy and created so many profits. So I think it had much less to do with the maestro Alan Greenspan and more to do with the natural cycle of the economy. Well, for all of Alan Greenspan's faults, you do have to give him credit for perfect timing. He did manage to retire just before the financial crisis hit, and he let all those problems fall into the lap of Ben Bernanke. Now, Bernanke was happy to take on that challenge. He was a student of the Great Depression, and he believed the only way to get out of that mess was to rapidly expand the Federal Reserve's balance sheet. We'll get into that in a minute. Now, when it comes to Bernanke, I prefer to watch what people do rather than listen to what they say. I find it quite illustrative that Bernanke, in spite of his defense of quantitative easing, he was very happy to quickly resign his tenure. He's been one of the shorter serving members of the Federal Reserve. Of being a chairman of the Federal Reserve. It seemed to me that he was happy to get out of the Federal Reserve, write his book, make his money on Wall Street, and let any of the consequences fall into the lap of Janet Yellen. So what is quantitative easing? Well, plain and simple, it's money printing. It's just a matter of creating money out of thin air. From Ben Bernanke through Janet Yellen, the Federal Reserve had 3 rounds of quantitative easing. They took their balance sheet from about $800 billion all the way up to $4.5 trillion. To give you an idea what that would mean, $4.5 trillion, that's about the entire value of the market capitalization of every stock in the Dow Jones Industrial Average. So think of the 30 biggest publicly traded companies that you know of. That would be ExxonMobil, Walmart, Procter & Gamble, Nike, AT&T, Verizon, just the largest companies in America, some companies that took over 100 years to build. Well, the Federal Reserve expanded their balance sheet by creating money out of thin air. Over a period of about 5 years, they created as much of the value as in the Dow Jones Industrial Average. That's what distorts markets. All that easy money floating around the system meant that interest rates continued to plummet and drop to historic low levels that started in 2006, just before the Great Recession took hold, just before the bubble blew up, and it went all the way through 2016. In fact, the Federal Reserve didn't raise rates over that decade period only 2 times. And that was in spite of the fact that in December of 2015, they said that they would have 4 rate hikes during 2016. Well, coincidentally, the economy started to pull back. This is during an election year. I think the Fed acted very politically, and those 4 interest rates that they said that they were going to do ended up being 1 interest rate in December of 2016, which occurred safely after the election was over. So as a result, we saw 10-year Treasury yields drop all the way down to about 1.3%. That happened well into the supposed recovery, and these rates today, as I record this, are still only at about 2.5%. That is incredible distortion. We'll get to that in a second. And speaking of distortion, as much as our Federal Reserve has intervened into our economy, other global central banks have acted more aggressively, and they actually drove rates to an extremely unprecedented and distorted rate of negative. That's never happened in the history of economics. And so where would our 2.5% interest rates be if they weren't so distorted? Well, this is a little esoteric. It involves some math and maybe some abstract thinking, but bear with me. It's generally accepted that the 10-year Treasury yield should equal the nominal growth of the economy. So using the Federal Reserve's own data, if you assume that inflation is about 2% and real GDP growth is about 2%, that would mean that nominal GDP growth is 4%, and so consequently, according to traditional accepted economic practices, the 10-year Treasury should be somewhere around 4%. Well, that's about 60% or more less than where it is today. That's the distortion I'm talking about. So why should you care about this distortion? Well, the fact of the matter is that all this easy money, all these artificially low and suppressed interest rates cause asset bubbles to occur. They reinflate the real estate market, they reinflate the stock market, and they reinflate the bond market. That was the purpose that they were originally used by the Federal Reserve during the recession, so that we could pull ourselves out of that and not go into a depression. The problem is that now we are 9 years into this supposed recovery, and they are still at the same distorted interest rate level. Now eventually they're going to normalize those rates. That's what the Fed keeps talking about bringing rates to a more normal amount. That would mean something in excess of probably 4%. And so what are the consequences of that? That's what you should be concerned about. And so to illustrate to you what increasing rates might mean, let's go over to Yahoo Finance. You'll see that I have a long-term chart of the 10-year Treasury yield up here, and you can see that rates started to decline in 2006, 2007 as we were entering the Great Recession. They reached a low bottom level here in the summer of 2016, right after the Brexit vote, and then since then they have been rising, especially very rapidly since the November presidential election. But in spite of the fact that it looks like they're going up quite a bit, let's look at that in terms of a moving average. Let's draw in there a purple line of the 12-month moving average, so it's about a 200-day moving average. You can see that throughout the recession and leading into the supposed recovery, that interest rates have been below that 1-year moving average. There was only really a brief time here when the market was skyrocketing in 2013 when they got above that 1-year moving average, and then just again about since the election they have broken out above that moving average. The Federal Reserve continues to jawbone, saying that they're going to take these to normal rates. Remember, at normal rates may be up here above 4%. That's quite an increase. What would that mean to you? Well, rising rates are likely to mean a decrease in the stock market and in a bond principal. And we can again illustrate that in Yahoo Finance. Let's turn off the indicator here, and this function up here in Yahoo Finance is very good to use. It allows you to compare something to another asset class. So in this case, we can click compare, click S&P 500, and it will draw in a line of how the 10-year Treasury relates to the S&P 500. Let's make that a little bit larger. And come over here by doing this. There we go. So the blue line is the S&P 500. The black line are the 10-year Treasury yield. You can see how they pretty much went lockstep with each other prior to intervention by the Federal Reserve. When the stock market was falling, interest rates came down as well. And then when the stock market started to recover, interest rates recovered. Well, that all fell apart really in a big way when the Federal Reserve launched their quantitative easing programs. And you can see that's where we got a discrepancy in the two. The blue line, the market kept rising and rising and rising as interest rates went lower and lower and then stagnated. Now, not only did the stock market go up, but so did other asset classes like real estate and also the bond market. And again, we can plug in a proxy for the bond market. Let's put in TLT. TLT. That's the 20-year Treasury yield. That's our green line. Let's make that larger. So now you can see that green line, it went up as well. And so the point to be made here is that when interest rates went down, the stock market, real estate, bonds all went up. And when interest rates start to rise, these other asset classes are likely to come down. We see that right here with the bond market. And let's in fact bring that into a smaller chart so you can see that. Let's look on a let's bring it down to a one-year basis. So the black line, as interest rates have started to rise, you can see the green line, bond prices are starting to come down, even though the stock market is going up. I think that disparity there is going to stop at some point as these interest rates continue to rise, and we're likely to see the stock market and the bond market both go to much lower levels if in fact interest rates really do normalize and they get up to be 4.5%. So the million-dollar question is, will the Federal Reserve really normalize rates and let rates get back up above that 4% level if in fact it could potentially have a devastating impact on not only the stock market but also the bond market? Well, we'll have to wait and see. We do know that in December of 2015, they took a very hawkish stance. They said they would raise rates 4 times. They ended up only raising rates once. I think it's very likely that they're going to raise rates next week. That's in mid-March of 2017 as I'm recording this. And we'll just have to see what they actually do and then watch the impact that it has on the stock market. It's really a no-brainer on the impact on the bond market. Bond prices always move inversely to bond yields. So as the interest rates move up, bond prices have to move down. That's something that's guaranteed. You can take that to the bank. If you're retired, if you're heavily invested in bonds, you've probably seen your bond funds losing money already. You should reassess that and take appropriate action. Well, we'll just have to see how this all unwinds and if in fact the Federal Reserve really does normalize rates. Until then, come back, join me on the next episode of the Wealth Studying Podcast. As always, this is John Pugliano wishing you the very best of returns.